Hello and welcome. Thanks so much for joining us on Retirement Solutions, the podcast. We've got a great show for you today. You know, most people, they're going to spend decades focused on one thing, and that's growing their retirement savings. But, you know, we found that there's something else that you should be thinking about, something that could have an even bigger impact on your retirement savings, really, than almost anything when it comes to retirement. And what is that? It's taxes. Because here's where most people don't realize it's all too easy to trigger what we call the tax time bomb in retirement. You know, and if you're not careful, your income in retirement could push you into a higher tax bracket. In fact, could trigger taxes on as much as 85% of your Social Security benefits. It could double or even triple your Medicare premiums, and it could increase your required minimum distributions. Why? It's because all these things are connected. And so today, we're going to talk about why tax planning for retirement is more important now than ever before. We're going to talk about how withdrawals from your IRAs and 401ks could trigger massive tax bills, why your Social Security benefits could be taxed at rates that you've never expected, plus what we call the holy grail of retirement tax planning that could help you sidestep the tax time bomb. So Tyson, let's dive right in, man. Why is tax planning and retirement so important?
Yeah, here's the key. You know, so many times we have somebody walk through our doors in our office and they say something like this: I've spent 30 or 40 years working and I've got a great nest egg, but I just realized after a public event that I went to from B.O.S., or, you know, maybe listening to us on the podcast or on a radio show, that they realize for the first time the taxes that they're going to be paying in retirement. And they also recognize that this could be one of the biggest financial mistakes that anybody makes. And here's the next piece of this, is that so many people assume that I'm going to be in a lower tax bracket and taxes won't really matter because I'm no longer earning a paycheck. And what we've found over helping thousands upon thousands of people retire is that these assumptions are so wrong. And so that's what we want to talk about with this first tax trap: is everything in your retirement plan, it's connected. All of your income that you start taking from your IRA or your 401k, maybe it's your Social Security benefits, maybe it's other investments like real estate. It all gets lumped into one big tax bucket. And before you know it, your taxable income could end up being significantly higher than you expected. In other words, just because you're not getting a paycheck from your regular job, you still need a paycheck from what you've been saving and thinking about using for retirement. And once you transition that, you've got to make sure that these taxes don't get out of hand and that you have this ability to be able to control the taxes. That's why one bad decision in retirement could trigger a tax time bomb and lead you to be paying way too much in taxes. And Ryan, maybe you've got an example of somebody that was using a spreadsheet, thought that they knew what they were doing, but then it really woke them up.
My two favorite groups to pick on a little bit, in a nice way, of course, are engineers and actually accountants. And here's why: because they get so used to the math and the spreadsheet. And you know, I was thinking, I was at lunch with my boys the other day, and I saw this guy and he had this shirt on and he said, I'm an engineer. And then it said, let's just start with assuming that I'm right every time. And I thought it was so funny because it was so classic, because I found so many times when people are good at math, like an engineer or a CPA or an accountant, they start to rely on the spreadsheet, and I say you can't see outside of the spreadsheet. And so, you know, one of the things that they'll do is they'll build their spreadsheet, and they'll forget things like inflation, or they will forget things like how these things all come together. You just said that everything's connected, and it is. Your Social Security and how you take your Social Security is connected to how and when you make withdrawals from your IRA or 401k. And, then that's going to play into required minimum distributions and all these different things. So, the good news is once you become aware that they're all connected, you can avoid a lot of these problems with some simple retirement tax planning strategies. And that's why we exist, Tyson. We want to help you get in front of it sooner than later. And so, Tyson, let's focus in a little bit. I think it would be good here to just talk about retirement withdrawals in your 401k or IRA, because this is one of those areas that so many people miss.
Yeah, this first principle of why tax planning in retirement is so important leads to this next step, which is retirement withdrawals and the IRA and 401k tax trap. We've kind of alluded to this, but when it comes to retirement planning, most people fail to ask themselves a really important question. It's this: which retirement account should I withdraw from first? Is it the IRA? Is it a 401k? Is it a Roth account? Is it after-tax savings? Is it Social Security? And the qualified answer to all of that is it depends, right? It depends on what type of account you have, first and foremost. Most people have a 401k. A lot of people don't have a Roth. Everybody has the opportunity to take money from Social Security. But the key on all of this is so many people don't recognize that it does make a huge difference. It matters a lot. And here's what we see quite often is we see people just get to retirement. Maybe they don't come and see us first. And they start thinking, well, I put money into my 401k every single month, every single paycheck, really. And so that's what I'm going to start withdrawing my money from first. Or maybe they say, I've got this IRA that I've rolled over some of my 401k money into. I'm going to take from both of these. They can be great savings vehicles, but when you withdraw money in retirement, you're going to have to eventually pay the piper, because you think about that IRA or that 401k, and it's taxed as ordinary income. You got the tax break when you put the money into it. You've been having this money grow in a tax deferred way. And so when you start withdrawing from it, the government wants their piece of the action. And when you do this the wrong way, it could easily make it so that you're paying too much in taxes, a lot more than you expect. And Ryan, when we get to required minimum distribution age, what happens?
You don't have a choice when it comes to your required minimum distributions. You have to. In fact, if you don't, you're going to get a 25% penalty. And Tyson, I was just thinking of a specific example. Had a client, they'd saved about $1 million. And when I met with them for the first time, they were doing what I talked about just a minute ago. They were just running everything off the spreadsheet. And so they looked at the point in time of when they retired. They were retiring at 62 years old. And, they were not going to start taking Social Security. They were just going to live off some of the income streams that they had. And that was going to get them till 70 so from 62 to 70, they were going to wait. The powerful thing about that is it did increase their Social Security check. What they didn't count on is those required minimum distributions that start at age 73. And, so at 73, all of a sudden they jumped tax brackets, because then they had to start taking withdrawals from their 401k. And I mean, if you think about the last decade plus, the stock market's been going up. So retiring at 62 with $1 million, and now all of a sudden you have the growth on it on your 401k, and now their 401k is worth 1.8 million. So it literally almost doubled during that time period. Now all of a sudden you have to start taking those required minimum distributions. It's the rough number. There's an exact calculation, but just the rough number. You've got to take about 4%. So when you take 4% out of that, all of a sudden, that's what you need to understand is that money coming from your IRA and 401k is taxed as ordinary income. So now all of a sudden, you've got this huge required minimum distribution. But wait, it gets worse, because every year Uncle Sam wants to drain that bucket. So he increases the percentage that you have to take out of your required minimum distribution. And, so I fast forwarded him to age 85. And, their tax bill It went from about $15,000 a year to over $100,000 a year because of required minimum distributions. And
It's
so,
incredible.
we were able to step back and look at this and say, this is not going to be a good long-term scenario. And I think that's the importance, Tyson, of long-term planning. If your tax bill all of a sudden goes from 15,000 to over 100,000, you're not very happy. And I think the other thing that people don't understand is that's also can increase your Medicare premiums, because Medicare premiums are means tested, meaning based off of the amount of income you have will depend on how much you pay for your Medicare premiums every month.
And really all this boils down to, in a lot of cases, instead of waiting for required minimum distributions to kick in, a lot of planners will say, well, put off taking any money out of those IRAs or 401ks until you get to required minimum distribution age, because then you can control your taxes. We look at it differently. We say, like in your example, Ryan, that it went from very minimal to $100,000, that we want to control upfront what we can control so you can control it throughout your lifetime. So what does that mean? It means in many cases, and everybody's different, but in many cases, it makes more sense to never have to worry about required minimum distributions, because we take care of the taxes before you get to required minimum distribution age, especially when we're at a 40-year low in taxes right now. And Ryan, when you talk about means testing, that's the next step that I want to talk about. But instead of Medicare, I want to focus on Social Security for a second and how this all relates to income, how it relates to means testing, because so many people think to themselves, okay, I was taxed on my money up front for Social Security. I had money taken out, in other words, for Social Security up front. So I'm not going to have to worry about Social Security being taxed when I get to retirement age. But depending on your other income in retirement, going back to IRAs and 401ks again, if you take this out in the wrong way, 85% of your benefits could be taxed, because they use a combined threshold for income to determine how much of those benefits are taxed. And so when you think about it this way, so many people don't recognize, oh my gosh, that Social Security check that I thought I was going to get is not all mine either. Just like the IRA check or the 401k check that I thought I was going to be able to pull out is not all mine, because these thresholds that we talk about for combined income thresholds from Social Security were never adjusted for inflation from decades ago. So many more retirees find themselves paying a lot more in taxes than they ever thought they would because of that. In other words, today there's this great article from Kiplinger talking about, and I quote, "Today, nearly half of all beneficiaries report paying tax on at least some portion of their Social Security income," end quote. And it used to be only 10% paid any taxes on their Social Security. Now it's half. And so you've got to have some planning. Otherwise, your money's just not going to stretch as far as you think it will when you get to retirement, right?
That's right. Tyson, we've talked about some of the problems here. What's the Holy Grail, right? After all of these years of experience, what's the Holy Grail? What's one of those ways that you can avoid the ticking tax time bomb? And that it comes down to planning. And one of our favorite strategies is a Roth conversion. And so here's why a Roth conversion is so powerful. Well, first of all, if you've got that money in your IRAs or 401ks, you can convert this over to your Roth, and you can do it in a systematic format that allows you to pay taxes on the amount of money that you convert now at tax rates. Now, remember, today's tax rates are at over 40-year lows. And once that money is then converted over into the Roth, so you're going to go through the tax gate, you're going to pay some taxes, but remember, you're going to do it strategically so you can control that tax rate. And now, when you get into retirement and you have all that growth that grows tax-free, now all the money coming out of that is tax-free as well. Well, this is not just tax-free coming out of your Roth IRA, but it also now this is going to impact what happens with your Social Security. It's going to impact what you're going to have on your Medicare premiums. And so it's a very, very powerful tool. Now, This is not a do-it-yourself project because Roth conversions, they're not right for everyone because you have to keep in mind you are paying the taxes up front. And so you need to look at this in a very strategic way. This is one of those areas that, you may want to do a home improvement project on the weekend by yourself, but I'm telling you what, a Roth conversion is not something you want to do by yourself. You want to have an expert that does this time and time again to help you be able to optimize the tax brackets in your favor. And this is, Tyson, this is one of those areas that people just love what we do at B.O.S. Retirement Solutions and Advisors because of the Roth conversion strategies and being able to think about it in a strategic way. And this can literally be tens of thousands, if not hundreds of thousands. For some people that have saved a lot, it can be millions of dollars in tax savings over their lifetime. And that is the ultimate way to help you avoid that tax torpedo.
Let me summarize a couple of things here. This is why tax planning matters. What we just went through, these 4 different pieces, the goal is to coordinate all of your income sources to keep your overall tax burden as low as possible. And we do it all within the context of the B.O.S. Retirement Blueprint. First off, you need to understand why we call our company B.O.S. Retirement Solutions and Advisors. B.O.S. stands for Build the Optimal System of Security. We help you to do that through the systems that we've created. And it's our simple planning process. You have to understand that there's less than 20% of any financial advisory firm that actually creates a plan for you. Most, all they want to do is they want to grab your assets. Let's say you've got $1 million. They want to take your assets and they want to put it into the market where they can make some money or whatever they want to invest in. Some people are doing alternative investments right now. Some people do annuities. And you want to work with somebody who can do any of this stuff, but you want to have somebody who, first off, actually creates a plan for you that is flexible and that's going to help you to last not only before you retire, but as you enter into retirement. And then whether you're 20, 30, 40 years in retirement, that it continues to be flexible. And you need to look at it from the perspective of how we do our planning. So we look at it from a cash bucket perspective. We then look at it from an income bucket perspective, a growth perspective, a tax perspective, and then a legacy perspective. And all of those levers, the biggest needle mover of all of them is making sure that first you understand what the income is going to look like. That's needle mover number 1. And then needle mover number 2, which really generally becomes the biggest needle mover over time, is how much you can save in taxes, like we've been talking about today. It really becomes this approach where we call it stacking because we stack the benefits of what you're going to do for income and maximizing your income with what you can do with growth, minimizing the fees you're going to pay and minimizing the risk you're going to be taking in the market to maximize your results, and then minimizing how much in taxes you're going to pay so you can use all of that money to your benefit as much as possible throughout your retirement years. And then still, if you decide to, pass on what you don't use as a legacy to either organizations or family members that you love. And so this planning process becomes the key to all of this that's going to make a big difference throughout your retirement years.
Tyson, I love that. We've talked about today how easy it is to trigger that tax time bomb in retirement and how it could ultimately cause you 6 figures in unnecessary taxes. Think about that, Tyson. I know for certain there's a lot of the families that we work with, they could think of a whole lot better things to do with, hundreds of thousands of dollars in tax savings than just pay it to Uncle Sam needlessly because they didn't stop and take the time. And that's why retirement tax planning could be one of the most important tools that you use. So come in and have a conversation with us. We have what we call the B.O.S. Retirement Tax Savings Analysis. It's not some off-the-shelf report. It's completely customized to you. And, this analysis, where you're going to see exactly how much you're projected to pay in taxes when you take a look at this versus how much you could save if you just use some proven strategies. So, the strategies, they're going to work best, we found right now, for people that have saved at least $300,000 for retirement. And because that's where taxes often start to do the most damage. And, of course, if you've saved more than that, let's say you've saved 3 million, it's going to be significantly higher. So we would invite you to come in, have a conversation with someone on our team to see how much money you could save in taxes when you retire. So give us a call. You can click on the show notes here in the link below, or you can give us a call at 800-769-7550. And that's 800-769-7550. Tyson, we love just helping people just like you be able to keep more money in their pocket and enjoy a secure and independent retirement, right?
That's right. This is so important. This is our mission. This is not just something that we get excited about. We're passionate about changing people's lives by helping them to understand the frameworks that we've discovered and really to make this simple. And how we feel about this is that if you don't understand the how and the why behind what you're doing, you're never going to get to what that really important next step is in your retirement life, which is doing exactly what you want to transition into. Maybe it's continuing to do some of what you love in a different way. Maybe it's going and donating time to your favorite charity. Maybe it's spending more time with your grandkids. Whatever it is, the B.O.S. Retirement Blueprint, this tax analysis, this B.O.S. Retirement Tax Savings Analysis is going to give you clarity into what your next step looks like. So thank you so much for joining us today. We appreciate you listening. And remember, retiring successfully today, it doesn't happen by accident. It starts with a plan. That plan is the B.O.S. Retirement Blueprint. Thanks, everybody. We'll talk to you soon.